The Seattle-Tacoma MSA. A market analysis. Presented by Park Place Investment. The Seattle MSA has bucked the trend of growth and negative net migration for West Coast cities with higher costs of living. It is the 8th fastest growing MSA of the top 25, and ranks as one of the top MSA for net inward migration. The current population is 4.1 million. This is a 1% increase since 2020. Seattle's population has been on a steady upward trajectory over the past decade, marking a 15.4% increase since 2010. This rate is more than twice the national average, and it is expected to continue for the next 5 years. The prime multifamily renter cohort, consisting of renters between the ages of 20 to 34, accounts for nearly a quarter of the metro's population at 23%. Over the next 5 years, the prime renter cohort is expected to expand by 0.3%, compared to negative 0.3% nationally. The merger of the Seattle and Tacoma ports has made the region the 4th largest shipping port in the country. The Seattle MSA punches well above its weight economically. The Seattle MSA economy is diverse, boasting a massive tech presence, as well as government and military, defense, aerospace, manufacturing, shipping and logistics, and green technologies. The strength of the local job market, however, depends on a handful of large employers, including Amazon, Microsoft, and Boeing, of which the latter employs nearly 60,000 Seattle residents. By the end of 2020, Seattle recovered 54% of the 329,100 jobs shed at the onset of the pandemic, compressing the unemployment rate to 7.2%. The hardest hit job sectors were leisure and hospitality. 27,300 net jobs were added in the first quarter of 2021. Moody's Analytics forecasts that employment growth over the next 5 years will expand by 2.9% in the Seattle metro, compared to 1.8% nationally. Seattle is expected to continue attracting Gen Z and millennial residents, due to the presence of well-paying high-tech jobs. The Seattle-Tacoma metro remains one of the nation's top markets for construction activity. Restrictions to construction sites and other challenges slowed deliveries in 2020. In 2020 only 6,802 units were completed. Capitol Hill and the Central District recorded the greatest increase to supply at 1,660 units, followed by Redmond where 1,050 apartments were built last year. However, there are over 72,000 units in the planning stages, and more than 21,000 units underway. Capitol Hill and downtown submarkets are scheduled to deliver approximately 7,300 units, or about 35%, of the total supply underway through 2022. Some notable developments are the Microsoft Redmond campus redevelopment, and the 896,600 square foot mixed-use Block V development in downtown. Transaction activity in Seattle slowed significantly last year. Only $1.6 billion in multifamily assets changed hands, the lowest volume since 2011. This followed 2019's cycle peak of $5.9 billion. Most deals were closed in the second half of 2020, after the health crisis-generated lockdowns were lifted. Despite the overall decline in volume, the average price per unit hit a peak of $348,483, a 17% year-over-year increase, and more than double the U.S. figure. The cap rates remain at 4.5%. Suburbs such as Bellevue East, Kent, and Renton were among the most coveted as investors looked to capitalize on growing tenant demand for more affordable areas outside of the city core. Following several years of consistent performance, Seattle's multifamily market ended 2020 in a difficult position. On a year-over-year basis, rents contracted by 6.2% in 2020, the 4th largest dip among major U.S. metros. Monthly effective rent is forecast to advance 0.9% in 2021. Of the 44 Seattle submarkets, only 7 saw positive rent movement in 2020. Rents dropped significantly in some of the most expensive areas such as Bellevue West, minus 6.4% to $2,437, and Belltown, minus 11.6% to $2,300. Meanwhile, the highest performing areas were southern submarkets Federal Way and Des Moines, with an average rate hike of 2.9% and 1.8%, respectively. In 2021, the overall vacancy rates in Seattle will be at 5%, however, the vacancy rates at the more expensive neighborhoods such as downtown and Capitol Hill will be in the 9% range. Suburban submarkets such as Bellevue East, Kent, and Renton, with limited pressure from new supply, have recorded strong tenant demand and falling vacancies. Tight Class B and C vacancy in most submarkets supports gains in these segments. Meanwhile, there were challenges to vacancy in denser neighborhoods of Seattle and Bellevue. Concessions in the Seattle metro area for Q4 2020 were approximately -2.4%, compared to -0.7% in Q4 2019. Furthermore, the discount on rents for Class A properties was about 10 days of free rent in Q4 2020 compared to just 3 days in Q4 2019. Looking forward, hiring across all sectors, along with the increase in minimum wage, should boost apartment operators' ability to increase rent. Also, another factor contributing to residents selecting renting over homeownership was the 14.8% annual increase in the median single-family home price. There are many reasons for optimism, however, investors need to be aware of certain risk factors. The cost of living and doing business is high in Seattle, versus other top 25 MSAs. As of January 1, 2021, Seattle's new corporate payroll tax has gone into effect. As a result of the new tax, companies with payroll taxes greater than $7 million will be charged a new set of taxes for different salary ranges. These new corporate taxes will make retaining employers difficult as they look to trim costs. Boeing dealt with various setbacks over the past several years, and the severe reduction in air travel due to the pandemic has only exacerbated its troubles. Boeing has been reducing headcount since announcing last May that it would lay off 10,000 workers in the state of Washington, in addition to relocating some of its manufacturing jobs outside of the Seattle metro area. For further information on Seattle, Tacoma, and other MSAs, please visit www.parkplaceinvestment.com.